Hi, welcome to the show. Tell me your name and what do you do in real estate?
Good morning, Hedda. I am Sanjeev Bhatia. I buy value-add apartments in Los Angeles. I am a owner-operator, uh, buy small multifamily from 2 to 4 units and on a 5 plus under 25 units in Los Angeles. And right now I have a multifamily value-add fund where I bring the limited investors, where I grow and preserve their wealth.
So, how did you get into real estate?
Hedda, I started in the real estate right after the college. So I bought a agricultural land, I bought a development land, and bought some small properties here and there. It was not a full time, and I learned my lessons where, development lands in especially if it's not in the metro area, uh, you have to wait for those ones sometime a decade or more than a decade without seeing any profit out of those properties. And after that, I just stick with the small multifamily properties with my corporate job, where I was buying one or two properties on the side and increasing the value, managing in-house, and refinancing those properties, and then buying more. That's how I built my portfolio and got to the point where I replaced my W-2 income with my rental income.
So, tell me about your first experience. How did you find the property? How did you know how to evaluate the property? And thirdly, did you have a mentor to help you?
I will say ignorance was bliss. I did not know any better. I would start buying the properties in my backyard where, you know, I was looking the properties on the MLS, on Redfin, on Zillow, and then comparing those properties. So now you underwrite enough properties, then you can see, okay, this property is checkbox in a price per square feet with the rental income, bang of my buck. And now then I go after that property. At that point, my goal was not even cash flow or anything. My goal was that how I can just buy that property and gonna keep that property forever. That's how I build my portfolio.
But what price point, how did you know even what to look for in the range? Was it something that was advised to you? Okay, you should be looking in the $1 million to $3 million range. How did you even know where to begin?
I started with my lender, what the lender say what I can afford. And within that price range, now I can go a little bit higher because beauty about buying the multifamily properties because your income from those properties also cover the debt. And at that point, after that is my goal was how I can come with a down payment and then look enough properties in all the areas. And at that point, I started in a B minus C neighborhood where there is a price per door is cheaper than B or A minus neighborhood. And that's how I started, then manage in-house, run the ship very tight, basically doing the property management in-house and, doing everything to save operating expenses so the properties can be profitable. And especially when there is a rental turnover and everything, I was turning the units in not even in a week, sometimes in a days.
So when you were approaching the building and you were looking on MLS, did you work on LoopNet at all? Because that seems to be a great place also to find some really great multi-unit buildings.
Exactly. Yes. Before I was buying more smaller, like properties under 4 units. At that point, because some of those properties are not on LoopNet. LoopNet has majority is a 5 plus. So sometimes the residential broker they do not put their listings on the LoopNet. I don't know if anything changed right now, but majority of like you see, especially on the MLS and Redfin, you will find every single property on a
So
smaller size property.
exactly. Did you start in the LA market or did you start looking a little bit outside of LA, little towns outside of LA?
Right in LA,
Very
right
good.
in LA, in
And
South Los Angeles, in the Inglewood. And so also let me just share that I had no gurus, no mentor. just like, doing everything by my own, just looking, okay, if I'm buying the property in a Torrance versus buying the property in Inglewood or in Hawthorne, where I can get the most bang of my buck, where I can get the more rents, where I can just turn the units quicker, and all those stuffs. I was just looking, and I was buying the property, and got to the point where I own six properties, a small multifamily, and then at that point I start networking, start meeting with other people. Then at that time I heard the word BRRRR. BRRRR is a buy, rehab, rent, refinance, and repeat. That was a cool word. And I realized I've been doing this exactly the same thing, which is the people have even wrote books on that same subject. This is like, exactly, it's even on a big apartment is the same thing, but they don't use that burst strategy. But in the small and on the big, that's what I was doing. And that's how I was just building my portfolio.
So can you just take me through the math? So you see something in, let's say, Inglewood, which I love Inglewood actually. I love all these small towns outside of, the main hub of LA. Uh, the architecture is beautiful. I love like even near USC, the architecture, just the pool of tenants. It's just a hodgepodge of amazing, eclectic people that are just moving because they can't afford the main LA rents, like Santa Monica, Brentwood. You can't afford it. So I just feel that people just always want a good roof over their head.
You cannot time the market. It's about time in the market. If you hold the property for long, even in 2008 or 9, that was the Great Recession, whoever just hold the property at that time, all the value came back by the 2013, 14s. The values were back, and even interest rate went down. Some of them who were hold and refinance actually made money, a lot of money at that time. If you don't have to sell, you always make money in a real estate, as long as you're buying in a in a city like Los Angeles, or like in the big major cities.
Right, close to a major city. So, what are the top five mistakes you would say first time investors are making? I know my big top mistake was selling too soon before I had a chance to really max out the equity because I got scared in 2008. I sold. I was like, okay, I got to get out. I ended up doing a 1031 exchange back then and did spiral into getting into other things, but I still probably could have bought other units without having to sell that property. So I also had no mentor. So it was just learning. And now that I'm in my 60s, it's like, gosh, I know so much now. And that's why I became an agent because of all the knowledge
Yeah.
that I acquired. It's like I need this outlet to share it with other people, what I learned. The secret for me was, like you just said, if you can hold on as long as you can, you'll make
Yes.
money.
You are the operator. So you are not just the like just the agent who just selling the dreams or anything. You are agent, you know that you buy and you hold, you're going to make money as long as you buy in close to the major cities and you hold it, you're going to be okay. So now you ask five major mistakes. I will say like it sometimes a first time investor they buy the property without doing the homework and without knowing the area. They just depend on others people's experience because they heard, oh, that market is good without knowing the rules and regulations as well. And also, sometimes like there is a lot of gurus and experts say that real estate is a mailbox money, is a passive. It can be a passive if you are investing into those with a good sponsor where you're a limited partner. But if you're buying by yourself, it is not passive. Even if you give to the property management company, first of all, it's very hard to find a good property management company. If you have one, make sure you just say thanks to them because it's a thankless job. But even if you have a property management company, you still have to manage the property management. So it is not a passive income. It is not a mailbox money. You have to uh, manage that property. You don't have to work full time, but you still have to manage the property. And third, I will say, most of the investor, they underestimate the operating expenses. Like, especially if they just see the performer, let's put if they're buying a multifamily, small multifamily or big multifamily, they go by what the performer is on the offering memorandum put together by the seller or the broker, because they do not operate in that market. So they do not realize there are much more operating expenses or much higher as well. What is on the offering memorandum or what's in the brochure? For example, right now, insurance premium are double or triple. Your operating expenses, your labor and material cost is double. And at the same time, so many other hidden expenses, they are not aware of that. So always assume more operating expenses from the starting. If you don't spend, that's good. That's, icing on the cake. And especially on a multifamily, I'm in a multifamily, I can say that from the new investors is picking up the tenant without doing the background check. It is like, especially the markets like Los Angeles, where laws are in the favor of tenants. Picking up the wrong tenant can cost you a lot. Is sometimes eviction can take much more longer if they don't pay the rent, and at that point, that operator or the owner will be in a very tough situation. So spend time on picking up the right tenant. That's if I say that on a multifamily, that just falls even before even operating expenses and other stuff. And the last one I will say, sometimes the investors wait too long to buy their first property. It's like, kind of, if you can afford to pay the mortgage and you did your homework, then pull the trigger. As I said, that if you holding for a long term and you can pay the mortgage, you can manage the property, you'll be fine. So those are the, like, I will say, uh,
Yeah, those
comes in my
those are
mind.
those are amazing top five mistakes that first time investors make because it all starts with homework and then just pulling the trigger. Are you a lender as well, or are you just doing this for yourself? Do you do this for other people?
No, I'm not a lender.
Yeah.
I do a syndication, and I run a multifamily fund where I bring the passive investors. So I'm the sponsor. I'm the one who just run the show from A to Z. If investor comes in, they are pure passive. So they are not operating the property, they're not signing on the loans, and they get a passive income and the tax benefits. I'm running a multifamily private equity fund, which is we are raising a 50 million, where there is a investors, different investors type. They all has to be accredited investors. So minimum investment is 100,000. And then if somebody's investing over $1 million, they got into the different category. So
So
those are
you,
not small investors.
okay, so these are people that have did you say $100,000? So
Yes,
so anyone listening out there that has like say $100,000, they can put that $100,000 into one of your buildings that you're gonna put them in a good, a good place, a good building. And then what kind of returns how much can they make when they sell out? Or how many years do they need? Like on arrivedhomes.com, you have to hold on for at least 7 years. How many years do they need to be with you?
exactly. I think we are a long term. Our approach is a long term. We hold for 7 to 10 years. Can we exit before? Yes. But anything underwriting before 5, 7 years is not realistic, especially in a market like today. So, when the market is up, everybody look genius. Everybody make money. You can turn around the properties in a 3, 4 years, can make a double or all those other incomes, like a profit you can share with your investors. But in a reality, it takes 7 to 10 years. So we have the same 7 to 10 years hold. Our target rate of return is the 13% on the minimum side.
That's huge. So if in 7 to 10 years one of your investors said, "Okay, I'm done. I want to pull my money out because I want to do something else," you're not selling that entire project or that entire property, or you just buying them out and then you have another person to fill those shoes. How does that work?
Normally, our goal is to, after 7 to 10 years, we start exiting those properties.
Oh, okay.
So we start exiting that property, and then at that point, because at that time we already max the value, net operating income, we already at that point if the market is in our favor, we sell those property at that time. Before that, we can do refinance on some small properties. We do sell and we put it back into the fund, and we keep buying those more properties. After the year 7, we start exiting the properties, and then we give ourselves 3 years after that to make sure that we don't want to sell when the market is down, because you lose money when you're forced to sell. At that point, like at the exit, we split our share with our partners.
So when you exit the property, since you must have so many people involved, how does a 1031 exchange work then?
1031 exchange, it it is possible, but it is little challenging in a fund or a syndication. Unless it's a group of investors, they all agree that they do not want any cash. They want to put all the money into the another 1031, then we can do.
People think it's a get rich, let's buy these multifamilies and we're going to get rich. You
Hmm.
have to do the work. If you're not doing the work yourself, you're not going to make money.
Exactly. I, you know, all these things with I've been doing this for more than 2 decades, and I'm still learning every single day. And I'm sure, all the knowledge I have, maybe next year, my underwriting going to change again. Not the fundamentals, but things change. Like it depends on new rules and regulations coming. Depends on how the labor and material are in the market, and insurance or something else. Is this what when you have the experience over the years, you know that, okay, you know what, I need, if I'm buying the next one, I went through that on that, like in previous deals. These are the experience I want to make sure that I avoid, and I underwrite. This is what it's going to cost me to run this property. So that's why, you can read as many books as you want, but the experience you're going to have, that's why it takes time. If you made a money in a real estate, flipping one house, or maybe at the right time you bought the property, that does not mean that every single properties you're going to buy, you're going to make money. And and also I always say that if you did not lose money in a real estate, do not think you are smart. It means you did not do enough deals, because the chances are you're going to buy some property where you're going to lose money. So now the question is, if you lose money, if you buy the bad property, your first or second, that will be end of your real estate journey. If you bought a good properties and then by the fifth or sixth, you lose money, you're going to survive because you have income coming from the other properties. And you know that you can make money in the real estate as you're going to hold for long term. So that's why doing the homework is very, very important.
So to conclude, can you give me the top? I always ask for the top three because there's just probably dozens. So I like to narrow it down. The top three mistruths that people are being fed through TikTok, all these real estate experts telling them to get into the rental property market and how they bought a house for, you know, 300,000 and they're in a $500 a month positive. They never really tell you the numbers. They don't tell you the breakdown of, how did they get to that 500 a month positive? What are the mistruths and the lies that people are being fed right now on the internet?
This is a good question. You know, I think there are tons of gurus who are selling, books and all those boot camps and everything. And then you need to look, are they real operator, or their business is sell the books? And you will find 90% are not real operators. Their main income is selling the boot camps and selling those books, selling the dreams. And so you need to just learn, go over there, but do your own homework because real estate is not a get rich quick overnight. It is rich for sure, but it takes time.
I'm going to say this now. I know we're still recording. Have you been to any of these seminars that they go come to a free seminar and we're going to teach you how to get involved in multifamily investing? I go because I just want to hear the lies that they're spitting out. And I'm sitting there like you saw me squirming at that seminar I met you at, squirming with some of those speakers. And obviously, I'm not going to mention their names, but I go to these seminars just so I can see, for myself, more lies that are being fed to people. These are people that they're asking you at the end of the seminar to sign up, for $3,000 or $5,000 boot camp for 3 days, and you're going to walk out of there knowing, everything about real estate. And my heart goes out to these people because they are in the back with their credit cards, and they don't have this kind of money.
I've been to the multiple those seminars and webinars where, come for 300 and then at the end, somebody sitting on the back selling all those, courses. We used to call tapes, not anymore tapes or CDs. Um, and there are some gurus out there charge 40s, 50s, $60,000.
Oh, I didn't know.
Uh, yeah, so for them, when but some of them are like paying with a credit card, and even those gurus knows that 98% or 99% the people who are signing up, they're not going to make it. They're very well aware of that as well. As I said, that their business is to sell the courses. They're not the real operator. Uh, but people are willing to pay, and these guys, why go manage the properties and become a real operator when they can make more money by selling the courses? There are more gurus than the operators.
Absolutely. You're so right. And I just love talking to you. I learned so much. This obviously should be we'll do a two-parter. We'll come back and do this again. What markets or cities do you feel people should be looking at rental properties in? Like how can they learn about what markets, not everybody's going to come to LA. This is for YouTube what we're doing today. So we're worldwide. But are there US mar or do you just study the Southern California market?
Hedda, that's a great question. I think invest in your backyard. When I say backyard, where you live. You don't have to like even in Los Angeles, which is one of the most expensive real estate in the United States, or you can say even in the world. And still you can make money in your backyard. Same thing, operators who are from New York, they make money over there. Because if our cap rate is low, at the same time, when we increase the value of the property huge, big time. So wherever you live, you can make money. You don't have to buy 10 or 20 miles from where you live. You can go 1 or 2 hours drive. Just go outside of Los Angeles or outside of wherever you live. And I think you can make money in your backyard if you do the homework. You don't have to just go buy big property. You can start with a duplex. You can start with the under 4 units. You can house hack, and the income from the if it's a fourplex or it's a triplex, from the other 2 or 3 units, the 75% of that rental income goes towards paying the debt for your qualification for the loan. And now, there are some they want to say that, oh, I need to have a front yard, I need to have a backyard, and all those other stuff for your first home. But if you want to get into the game, just do the house hack and then buy your dream house, the second or third. And now you're going to have income coming from that fourplex. That's the one way to get into the real estate, but just buy in the backyard.
Amazing. Well, I'd love to have you come back and I'd love to talk about more specific models of ways that you can approach buying your first investment. Like you just said, duplex, fourplex, or single family house. And I think we need to then dissect when you're buying duplex, fourplex, and or above, multi-family units. I think you have to analyze your purpose. Do you want it for the income or do you want it for the appreciation? Because apartment complexes don't appreciate as quickly as a single family house if you want to start getting into the investment game. If you
Yeah,
only have, let's say, 100,000, do I take that 100,000 and put it in a single family house? Or do I put it in a duplex? Because if I'm trying to sell that duplex in 7 years, is that duplex going to appreciate as fast as the single family house?
so there are two kind of in a multifamily. If you're under 4 units, it's the same like you're buying a single family because the price of those under 4 units is going to be based on the comps. But when you're in a 5+, it's all about the net operating income. There can be a 2 10 units property next to each other, same year, same bedroom size. But if the one property has a $10,000 income, the other one has a 20,000, the property has a 20,000 income going to have a double the value. But that doesn't happen under the 4 units.
Right.
So when you're buying those 5+ unit, you increase the value, net operating income, the value of the property goes higher with that. But when you are under 4 units, it all depends on if the properties in that neighborhood is appreciating, then your property will be you're going to sell the property based on the comps.
Amazing tips, just brilliant. I can't thank you enough. And if people want to get in touch with you, what are you looking for in potential investors other than money? Do they have to get involved or is it just writing a check and they trust that you guys are gonna, put their money in a good place?
We are looking for accredited investors. There's 100% passive. They don't need to deal with the tenants. We take care of everything. And it's a we buy in a Los Angeles in our backyard, value add properties. We are also building the ADUs, which is very hot right now in Los Angeles. Last week, governor passed new law SB 1211, where on a multifamily property, you can build 8 detached ADU on an 8 unit property. So you can buy an 8 unit property. If there is a lot, there's a space on a back parking, you can turn the 8 unit to 16 units or maybe 18 units. Because you can, I don't want to get into too much, like you can build 25% attached on a multifamily. And then it used to be a law that you can only build 2 detached ADU, but now you can build up to 8 units. So
Okay.
this is a game changer for Los Angeles.
Okay, we're going to continue. This is going to cut out right, like literally in 2 seconds.
If somebody want to get hold of us,
Yeah.
is uh, LMEinvestments.com